Welcome to Taking Stock. I'm Amanda Lang. Coming up in the show, with inflation high in Canada, we are reading the tea leaves on where it goes from here and whether new government measures will make a difference. And speaking of tea, price pressures at the grocery store continue to be a point of pain. Plus, a bit of advice on battening down the hatches in turbulent times. That's all ahead. But first, inflation in Canada is still running uncomfortably high. And while our central bank tries to tame it, Canadians' expectations may be resetting at a higher level. Here's a look at where things stand by the numbers. Inflation in Canada slowed in July, if you can call 7.6% slow, but it was down from 8.1% in June, still a far cry from the target of 2%. A big part of the decline was one of the most volatile prices, gasoline, which was still up 35.6% in July compared to the 54.6% jump in June. Other big-ticket items still showed high inflation, but were either flat with June or slightly below. Shelter was up 7%, household goods up 5%, clothing was up 1.4%. But food grew even faster with a 9.9% price increase, meaning between eating, putting a roof over your head, and getting around, life is still pretty unaffordable. That means the pressure to increase wages is very real. It showed up in an increase in the average hourly wage of 5.4% to $31.33. That is helping send incomes higher, up 1% overall in the 3 months ending in June. That didn't keep up with consumption, though. It grew 4.3%. That all sent the savings rate down to 6.2%. But for many Canadians, that is still well above pre-pandemic levels, something the Bank of Canada is taking into account. A read on inflation south of the border this week is stoking fears that it has yet to plateau and, in fact, is still heading higher. Up 8.3% in August. That's above expectations, and it will cause concern about where inflation is headed here. We will find that out next week. But meanwhile, the federal government unveiled 3 measures aimed at helping some Canadians with inflation: a doubling of the GST credit for those who already receive it, at least for 6 months, a one-time payment of $500 to help people with rent, and a dental plan for children in lower-income households. Question is that enough to really help with prices that are rising at such a hectic rate? Benjamin Tal is Deputy Chief Economist at CIBC Capital Markets. Benjamin, great to have you with us.
A pleasure. Thank you.
So it doesn't hurt, of course, for low-income households to receive an injection of cash. Is it enough to alleviate their pain without causing more inflation?
No, it's not enough, and that's the situation that the government is facing. On the one hand, you really want to help, and they are helping, and I think that's a good thing. But clearly, you don't want to feed inflation because you have the Bank of Canada raising interest rates in order to lower inflation, and then if you have the government spending, it's like putting a humidifier and a dehumidifier in the same room, and let's see who wins. So this is something that you want to avoid, but clearly targeted help to people who need it is definitely the right thing to do. In terms of the macroeconomic story, what was released today is not really major in terms of inflationary pressures, so that's fine.
We talked a lot about the amount that households saved. A lot of them did, Benjamin, through the pandemic. Costs were reduced as we didn't travel, as we didn't go to the office, and we built up all these household savings. The idea was that, we might unleash them at some point, and that's creating inflationary pressure. Will that now work in our favor in an economic slowdown because we have a cushion? We might have more savings than we would have had otherwise. That's not true of everybody, but for some.
Absolutely. So it's helping, but it's feeding inflation because when you raise interest rates, you are expecting the consumer to slow down. But this consumer is sitting on a mountain of cash, and there is so much pent-up demand. So the consumer is not listening to higher interest rates and still spending. This consumer will actually surprise on the upside because of these excess savings, and it will make the Bank of Canada's job actually more difficult, ironically. And therefore, we might see actually interest rates rising faster and higher because of that.
And then you can almost picture a worst-case scenario, Benjamin, where we spend down our savings. If we're going to spend it, we spend it away, just in time for a pretty bad recession that we helped create by keeping on spending when the central bank wanted us to stop. Are you looking now at a harder landing, a bigger recession than you might have a few weeks ago?
To an extent, yes, because I think that the Bank of Canada and the Fed will be more aggressive because inflation is more sticky. So we are entering this overshooting zone that we have seen in the past. And in the past, almost every recession was helped, if not caused, by monetary policy error. And we are entering this zone now. The good news is that the labor market is extremely strong. And I think that we all agree that a real recession requires a significant pain in the labor market. So if we have 2 quarters of negative growth without a huge increase in the unemployment rate, in my books, that's not a recession.
We know, of course, with that labor market being as tight as it is, very healthy at the moment by all measures, that we will see wages go up, and they've gone up quite a bit. On a historical basis, you don't normally see 5+% gains in wages. Is this itself inflationary, or is it at a readjustment higher, a new reality of the labor market where businesses are going to have to pay more to get the workers that they want?
First of all, it's a clear signal that you have to pay more to low-wage individuals because we have been paying them much lower than market prices and wages, and this is a wake-up call. So clearly that's a good thing as far as they are concerned, and that's very, very important. But also we have to realize that at this point of the game, the lower your wages, the higher your wage inflation is. So the wage inflation is coming from the bottom, which means that it's more inflationary, because if you give an increase to somebody at the bottom, you also have to give an increase to somebody at the middle and at the top. It's very different than when the pressure is coming from the top, because it doesn't go down. So this is more inflationary, and that's one of the reasons why we believe that the Bank of Canada will have to be aggressive, and the Bank of Canada will have to keep interest rates relatively elevated for a longer period of time.
Benjamin, it is always so good to have you. Appreciate your time.
A pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist at CIBC. Coming up, continued high prices create pain for Canadians, nowhere more so than the grocery store. And as wages rise, will expectations create problems of their own? Stay with us.